our view has been that the Fed is going to keep on hiking rates into 2019. We expect them to hike rates later this month. We think they're likely to hike 3 or 4 times next year. But what has changed? What's changed is what Chairman Powell said last week, is that no longer is the Fed going to hike rates regardless to stem inflation in the future. They're actually willing to pause. They're willing to consider not even hiking rates in 2019 if the data continues to come in a little bit weaker than is expected in the US. Now, it's important to note that we've seen yields go up a lot already in the marketplace. And this is something that confuses investors sometimes. We're all taught that rising rates is just a bad environment for fixed income securities. That's not exactly 100% true. It's true that higher quality fixed income, such as treasuries, agencies, very high quality debt, doesn't fare particularly well when interest rates rise. However, higher yielding markets like corporate high yield, emerging market debt, and others actually can do quite well in a rising rate environment. The other thing as well is, while rates going up might mean prices go down in the short term, it sets us up for much better returns in the future. Here we show a very similar thing. You know, there's this, a lot of people think that until 2 years ago, we had 30 straight years of yields just going like this. The reality, as you can see from the blue line here, is that that's not true. There have been periods where rates have gone up. That's all the shaded gray areas. And what you can see is that in almost every period, higher yielding returns were positive, sometimes very positive. Very similar story in emerging markets. The only difference being a little bit more volatility. We'll talk more about emerging market debt later, but more idiosyncratic risk, which means that not always you have positive returns, but still, most of the time you tend to do well in a rising rate environment. Now, let's understand, the numbers clearly show that, but why is that true? Why do those bonds do well? Well, think about it a second. When yields go up, that's usually a sign that economies are doing well. Things are looking up. Probability of recession is down. So what do you think happens to what we call a spread? The risk you get to hold, the compensation you get to hold a risky bond, whether it's a corporate debt bond, a high yield bond, an emerging market bond, that compensation goes down. So that more than offsets the rise in risk-free rates. And that's why you can have pretty good returns over time. Okay, let's look at one more metric that I think puts into focus fixed income returns. So what we show on this chart, I want to spend a couple minutes explaining what this is. The darker blue line here, the dark line, is the yield in the high yield marketplace over the past 20 or so years. And it's actually gone up a little bit since we put this chart together. It's closer to 7% right now. And the lighter line shows what the next 5-year annualized return is. Now, I tell you why I pick 5 years. That's about the duration of the high yield market. That's the average time that a bond is outstanding. In any given year, returns are either good or bad, right? They were pretty bad this year. They were very good in 2016, pretty good in 2017. But over time, you pretty much earn your yield. That's what this shows. I'll give you an example. If you happen to have bought at the end of 2008 during the crisis when yields were 20%, your return over the next 5 years was 20% annualized. If you waited until the end of 2009 when yields dropped to 12%, well, guess what? You earned about 12% over the next 5 years. The point I'm trying to make is that at today's yield, I don't necessarily know what your return is going to be in the next 6 months, but I'm pretty confident that you're going to end up getting kind of mid-single-digit type returns because that's where yields are starting the period. And it's important to understand why that is. You start with a yield. If you're investing in risky bonds, you may have a loss rate. You'll have defaults. A manager like ourselves has had many fewer defaults over time than the market, but you're going to have some. And you make that up with what we call positive event risk. Companies, high-yield companies, get bought by investment-grade companies. Companies often take their debt out. They call the debt early for liquidity reasons at a premium, and that offsets your losses over time. So fixed income is a much more mathematical asset class. And over a 5-year period, it's hard to earn something very different than your starting yield. And in fact, we've never had 2 consecutive years of, at least in the past 30 years, of negative returns in the fixed income markets. So let me talk about 2 areas where we actually see a lot of opportunity today. The first might surprise you. It's in the energy sector. Because the energy sector is very different than it was 3 years ago when oil went down as much as it has recently. Then you had a lot of companies that had a lot of debt that only really could survive at an oil price of $60, $70, $80. Today, that's not the case. You know what happened to all those companies? They don't exist anymore. They went bankrupt in 2016 and 2017. They restructured. Today's companies are much higher quality. So the fact that energy bonds the prices have gone down as oil has gone down, that's actually a buying opportunity. The other place is in European banks, the subordinated debt of European banks. And this is a great example of how equity investing and debt investing can be very different. The past 10 years, the European regulators have spent a considerable amount of energy trying to get the banks to take less risk, not to invest in all these fancy derivatives that was partially responsible for the global financial crisis. Go back to the basic boring business of actually taking in deposits, lending them out, and earning a spread. That is not a good growth story. That is not a good equity story. And it shouldn't surprise anyone that the many European bank stocks have not performed well over the previous few years. However, it's precisely for that reason that it's a good fixed income story. I want to lend to companies that are more predictable, that don't take a lot of risk, that are going to pay me back at the end of the day. Remember, if a company takes a lot of risk, that really only benefits potentially the equity holder. I, as a lender, I, as a fixed income investor, I get paid the same amount whether a company does okay or does great. So the fact that the banks are taking a lot less risk is actually a really, really good opportunity. That part of the market hasn't done particularly well. It's a risk part of the market, and we think is going to perform well in 2019 and beyond.
投资一定有风险，基金投资有赚有赔。申购前应详阅投资人须知或公开说明书。